Hello, I'm Ivan Gruhl, Co-Chief Investment Officer with Avantax. Today we'll provide a market update for June. We'll start with a recap of returns for May, and then shift to an update on the trade policy, the big beautiful reconciliation bill, corporate credit, and our outlook going forward. As the saying goes, April showers bring May flowers, and after a turbulent April, markets found their footing in May, delivering a much-needed rebound and renewed optimism. Here in the U.S., the S&P 500 finished the month of May higher by more than 6%, while the Russell 2000 Small Cap Index rallied by more than 5%. For the year, the S&P 500 is back in positive territory, higher by about 1%, despite having fallen nearly 20% from the highs in early April. Overseas, international markets continue to show strong relative performance, as the International Developed Index is higher by more than 17% so far this year, while emerging market stocks are higher by nearly 9%. Shifting to bonds, it was a challenging month for fixed income investors who had to fight the uphill battle of rising interest rates. After beginning the month of May around 4.23%, the yield on the 10-year Treasury note finished the month around 4.4%. The taxable bond index ended the month lower by about minus 0.7%, while the municipal bond index was mostly unchanged. On the year, municipal bonds continued to lag taxable bonds, though the performance gap has begun to normalize. Through May, the taxable bond index is higher by about 2.5% on the year, while the municipal index is lower by about 1%. Angst around trade policy and tariffs have been the primary drivers of market volatility so far this year. And while we believe the worst of the volatility is likely behind us, the markets are still ripe with uncertainty. Between trade deals, court rulings, and subsequent appeals, the policy landscape continues to change day to day. It's unlikely that the markets will get more clarity on this front for some time, leaving many businesses in a trade limbo that could potentially have adverse effects for the economy going forward. On the policy front, President Trump's signature tax reform package passed the House in May and is currently awaiting action in the Senate. This chart from J.P. Morgan shows how this budget reconciliation bill could add approximately $2.3 trillion to the deficit over the next 10 years relative to baseline expectations. The green bars show positive effects, and the red bars estimate increases in the deficit. The first green bar on the left shows the major spending cuts, which are mostly Medicaid, food stamps, and student loans, followed by a red bar which shows the substantial projected costs of extending the Tax Cut Jobs Act. It is important to note that these impacts are static, meaning that they do not include whatever benefits may accrue from additional growth due to stimulus, and they exclude tariff revenues. In any case, the federal debt is likely to continue to rise meaningfully over the next several years, and the bond markets have taken notice in the form of higher interest rates. Looking ahead, we remain encouraged on the corporate and economic fronts. Corporations are in a position of strength and should be able to weather any downturn, as highlighted in this final chart, which shows historically low default rates for high-yield bonds in the U.S. Separately, S&P 500 companies grew earnings at an annual rate of 13% in the first quarter of the year, nearly double what analysts were expecting coming into April. And turning to economic growth, the Atlanta Fed's GDP Now model is projecting real growth for the second quarter to come in around 4.6%, a strong rebound from the negative GDP print in the first quarter. We continue to see inflation trend downward as we monitor the effects of tariffs on inflation readings in the months ahead. In aggregate, the data continues to point toward a relatively stable economy that should be able to expand through the rest of this year. So that's what we have for this month. Thank you for watching and have a great day.